Let me ask you something. Do you still see Bitcoin as the rebel of finance, the ultimate outsider? What if I told you it's not the hedge against the market you believed it was? What if it's becoming part of the very system it was meant to shake up? Believe it or not, something surprising is happening. Bitcoin and the S&P 500 are starting to move together like unlikely dance partners. This video explores the evolving relationship between Bitcoin and the S&P 500, uncovering a trend that's changing how investors view these assets. We'll break down the increasing correlation between the two, analyze whether Bitcoin is still a hedge against economic uncertainty, and examine how institutional adoption is reshaping its role in financial markets. We're going to dive into the real numbers. I promise this is something you need to hear. In its early days, Bitcoin was the hedge of the financial world. If stocks crashed, Bitcoin could soar, or at least hold steady. It was exciting, unpredictable, and most importantly, different. But that's not the case anymore. Over the past few years, Bitcoin started to exhibit a surprising trend. Its price movements increasingly mirror those of the S&P 500. The 90-day correlation between the two hit a 17-month high of 0.49 in 2023, a level previously unheard of in Bitcoin's history. For context, a correlation of 1 means two assets move perfectly in sync, while a correlation of -1 indicates they move in opposite directions. Bitcoin's correlation with the S&P 500 has historically hovered closer to zero, reinforcing its reputation as a unique asset class. This shift means Bitcoin is behaving more like a traditional risk-on asset, moving up during periods of market optimism and down during periods of fear. As economic conditions tighten or loosen due to central bank policies, Bitcoin and equities are reacting in similar ways. But why is that happening? There's four main reasons. In recent years, institutional investors such as hedge funds, pension funds, and major corporations have entered the Bitcoin market. With these players, Bitcoin is increasingly treated like a component of a broader portfolio alongside equities. As these institutions rebalance their portfolios in response to macroeconomic factors, Bitcoin's price fluctuations align with other risk assets, like the S&P 500. Bitcoin is no longer immune to central bank policies. Factors such as Federal Reserve, interest rate hikes, inflation concerns, and fiscal policies now affect Bitcoin similarly to stocks. For example, during the 2022 rate hike cycle, both Bitcoin and the S&P 500 saw significant declines as liquidity dried up. As the Bitcoin market matures, its volatility has decreased slightly, and its behavior is starting to resemble traditional financial assets. This is a sign of growing stability, but also hints at its integration into the broader market. Both Bitcoin and the S&P 500 attract speculative investments. In bull markets, they experience inflows from risk-seeking investors, while in bear markets, they see outflows as fear dominates. Make sense? Okay, but if Bitcoin is moving in the same direction as your stocks, it might not be doing the job you think it is. Let's break this down so it's crystal clear. This shift in correlation is not just a statistical curiosity, it has real-world implications for investors. Investors often add Bitcoin to their portfolios for diversification, assuming it moves independently of traditional assets. If Bitcoin's correlation with the S&P 500 continues to rise, its ability to act as a diversification tool diminishes. Portfolio managers need to reassess how Bitcoin fits into their risk models. If it behaves more like equities, traditional strategies for balancing risk between stocks and alternative assets may need adjustment. Bitcoin's rising correlation suggests it is increasingly influenced by broader market trends, such as monetary policy and economic conditions. Understanding these relationships can help investors better anticipate price movements in both Bitcoin and traditional markets. Now that we've unpacked the correlation issue, let's tackle the next big question. Is Bitcoin still a hedge against traditional markets? Remember when Bitcoin was called digital gold? That idea gave so many people hope. In its early years, Bitcoin seemed to thrive as a hedge against traditional markets, particularly during times of global uncertainty. The narrative gained traction during the European debt crisis in 2013, and again in 2020 during the COVID-19 pandemic, when Bitcoin's price surged while central banks flooded the economy with liquidity. This narrative draws inspiration from gold, a time-tested safe haven during periods of inflation or geopolitical instability. But while gold's value is underpinned by centuries of trust and a finite supply, Bitcoin is still a relatively young and volatile asset. Its short history as a financial instrument leaves questions about its reliability as a hedge. Today, the story is changing. Bitcoin is behaving less like a hedge and more like a risk-on asset. Several key factors explain this shift. During the 2022 to 23 period of rising interest rates and inflation concerns, Bitcoin moved in tandem with equities, dropping sharply when the S&P 500 declined. This behavior contrasts sharply with gold, which typically rises during economic uncertainty. The influx of institutional investors has reshaped Bitcoin's role in financial markets. Many of these investors treat Bitcoin as a speculative asset, similar to tech stocks, rather than a hedge. Their trading behavior ties Bitcoin's price movements more closely to traditional market trends. For Bitcoin to function as a hedge, it must maintain stability during market downturns. However, its extreme price swings, sometimes losing 50% of its value in a matter of weeks, make it difficult for investors to rely on it as a protective asset. Bitcoin's status as an inflation hedge has been inconsistent. While proponents argue that its fixed supply should make it resistant to currency devaluation, empirical evidence shows mixed results. For instance, during the high inflation environment of 2022, Bitcoin's value declined alongside traditional assets. So what does the data say? Is Bitcoin still a safety net? Academic studies and market data provide insights into Bitcoin's evolving role as a hedge. I'll link them below. Research highlights that Bitcoin can act as an inflation hedge in certain market conditions, particularly in economies with high cryptocurrency adoption. However, this effect is not consistent across all regions or timeframes. Comparative analysis shows that gold remains a more reliable hedge against inflation and market downturns. Bitcoin, by contrast, is more speculative, driven by innovation and adoption cycles, rather than intrinsic stability. From now on, the question we should be asking ourselves is not what Bitcoin can do, but what it can't do anymore. Bitcoin's changed, but what's driving this change? Did you know that institutions now control a massive chunk of the Bitcoin market? Yes, big names are making big moves. Over the past decade, Bitcoin has transitioned from a fringe asset for tech enthusiasts to a significant player in global finance, thanks in large part to institutional adoption. The entrance of major financial players has fundamentally reshaped how Bitcoin is perceived and used in the broader market. Here are some key milestones. Companies like Tesla and MicroStrategy made headlines by adding Bitcoin to their corporate balance sheets, treating it as a long-term store of value. Hedge funds and pension funds, such as those managed by Fidelity and ARK Invest, began allocating small percentages of their portfolios to Bitcoin, citing diversification benefits and growth potential. The launch of Bitcoin ETFs, exchange-traded funds in multiple countries, including the US, Canada, and Europe, provided easier access for retail and institutional investors to gain Bitcoin exposure without directly holding it. Major financial institutions like BlackRock and Goldman Sachs now offer Bitcoin investment products, further legitimizing the asset. Companies such as Coinbase Institutional and Bakkt have developed custody solutions, allowing institutional investors to securely store Bitcoin. Blockchain technology has been integrated into traditional financial systems, providing infrastructure for seamless crypto trading and settlement. Countries and regulators have started creating clearer frameworks for Bitcoin investments. This regulatory clarity has encouraged cautious institutional players to enter the market. Now, here's where things get tricky. On one hand, institutional money brings stability. It makes Bitcoin less volatile and more credible. That's good, right? But on the other hand, there's a trade-off. These institutions are turning Bitcoin into just another Wall Street asset. Think about it: more regulation, tighter oversight, and higher correlation with traditional markets. And with that, we lose some of Bitcoin's original charm, the Wild West appeal that made it so different in the first place. So, if institutional adoption is a double-edged sword, how do you make sure it works in your favor? Now that you know how institutions are changing the game, let's zoom out and see what this all means for you as an investor. Understanding Bitcoin's shifting role isn't just theoretical, it's practical knowledge that can make or break your investment strategy. If you fail to adapt to its integration into traditional markets, you risk misjudging its potential benefits and pitfalls. Bitcoin's new relationship with traditional finance is a reminder of how quickly financial markets evolve. As an investor, staying informed and flexible is key to navigating these changes. So what's the move? Here's some things you can do to stay ahead of the curve. Reassess your portfolio. Consider Bitcoin's evolving correlation with equities and adjust your allocation to reflect its role as a risk asset rather than a hedge. Diversify. Further, to mitigate risk, pair Bitcoin with assets that have consistently low correlations with equities, such as gold, bonds, or commodities. Or another approach, Bitcoin as part of your risk-on allocation, sitting alongside high-growth equities or speculative tech plays. Consider its potential for high returns, but also its increased exposure to market-wide downturns. Bitcoin's performance is increasingly tied to global economic factors like interest rates, inflation, and geopolitical stability. Staying informed about these trends can help you make better investment decisions. With the rise of Bitcoin ETFs and custody solutions, it's easier than ever to gain exposure without directly holding the asset. These tools can help you manage risk and liquidity more effectively. If you're still on the fence about Bitcoin, let me lay it out for you. This is a moment to pay attention because staying in the dark could cost you. The Bitcoin story is far from over. As governments and institutions increase oversight, Bitcoin could become even more attractive to mainstream investors, or it could face barriers that stifle its adoption. Bitcoin may have paved the way, but Ethereum stablecoins and other digital assets are also evolving. These assets could complement or compete with Bitcoin in shaping the future of finance. The ultimate test for Bitcoin's role will be its performance during a significant market downturn. Will it retain its appeal as a store of value, or will it falter alongside equities? Bitcoin's journey from an outsider to a major player in global finance is a testament to its adaptability and resilience. Its integration into traditional markets underscores the importance of keeping an open mind and staying flexible in your investment strategies. By understanding where Bitcoin stands today and where it's headed, you're not just learning about cryptocurrency, you're preparing for the future of finance. If this video helped you better understand Bitcoin's evolving role, drop me a like. If you want to share your take on this, drop me a comment. Thanks for watching, guys, and stay informed. I'll see you in the next one.